Okay, let's just jump right in. It is Friday the 13th, February 2026.
Hmm.
And I have to say, if you opened your portfolio app this morning, that date feels a little too on the nose.
Yeah. Tense doesn't even begin to cover it.
The charts are just ugly. The sentiment is bordering on disastrous. And if you're feeling that, that knot in your stomach looking at the red, you are definitely not alone.
Not at all. The data we're looking at shows extreme fear.
Yeah.
It's one of those days where, the timeline on X is just a wall of panic.
And this is why we're doing this deep dive. We've pulled together a stack of sources that, well, they tell a story you were absolutely not seeing on the price ticker.
Right.
We have a prediction report from Bitwise that reads like science fiction compared to today.
Yeah.
We've got some brutal reality checks from Binance Square and CryptoSlate just to keep us honest.
And then the really heavy stuff.
Yeah, the heavy hitters,
Yeah.
dense legal newsletters, and this massive strategic framework from the SEC called Securing Digital Dollar Dominance.
And when you lay these all out side by side, the disconnect is it's jarring. It's probably the biggest gap between price and, fundamental progress that I think we've ever seen.
Exactly. On the surface, you have capitulation. Investors are hurting.
But underneath it all, in the White House, in the back offices of these huge banks, there is this unprecedented level of activity. The foundation is actually hardening at the exact moment the market looks like it's crumbling.
So that is our mission today. We are going to try to bridge that gap. We want to figure out why, if the market is crashing, the quote-unquote grown-ups in the room, the regulators, the banks are busier than ever.
We have to contextualize the pain. Because if you only look at the price, you are missing the entire architecture being built right behind it.
Okay, so let's start with that friction, right? The promise versus the reality. We have this 2026 outlook from Bitwise, and reading it while looking at Bitcoin, around 76,000, it just feels dissonant.
It is definitely optimistic. Bitwise is making a structural argument that, it challenges the historical cycles we're all used to.
You mean the 4-year cycle?
Exactly. Everyone expects that boom and then the bust. 2026 is supposed to be a pullback year. But Bitwise is calling for new all-time highs.
So they're just betting against history. What's the thesis? Is it just hopium?
No, it's based on supply and demand, specifically from the ETFs. Their argument is that these institutional vacuum cleaners, the ETFs that launched back in 24 and 25, are creating a supply shock that just overrides the old cycle.
A supply shock?
Yeah, they highlight that the ETFs have purchased more than 100% of the new supply of Bitcoin, Ethereum, and Solana.
Okay, pause right there. That is a wild stat.
It is.
If they're buying all of the new supply, plus some of the old, that should send prices to the moon. It's economics 101, right?
It should. But that's not what we're seeing.
No. I'm looking at the market analysis from Binance Square, dated February 2nd, and the reality is grim. Bitcoin is struggling to hold $76,800. Ethereum is barely clinging to $22.40.
And look at the sentiment indicators. The fear index is at 92.
Yeah.
92. That's off the charts. That's extreme fear.
It is. It basically means nobody wants to touch the buy button.
So if the institutions are buying everything, who is selling? Why is the price tanking if this supply shock is real?
That is the multi-billion-dollar question. And the CryptoSlate report gives us a clue. It points to a very specific group, the ETF holders themselves.
The people who just bought in.
Yep. They estimate that Ethereum ETF holders are sitting on over $5 billion in paper losses.
Ouch.
Yeah. The average buy-in for that group was around $3,500. So with prices in the low 2000s, their portfolios are deep underwater.
That is painful. So you've got retail, maybe traditional finance folks who bought the institutional adoption hype, and now they're panic selling because they didn't sign up for a 40% drawdown.
Precisely. It's a clash of timelines. Bitwise is looking at structural capital flows over a decade. The market is reacting to, hawkish comments from the Fed and anxiety around the new Fed chair nominee. It's short-term panic versus long-term plumbing. But there was one stat in that Bitwise report that really surprised me. They claim Bitcoin is actually calming down.
This is a fascinating nugget. We always hear that crypto's too volatile, right? Don't put your pension in magic internet money.
Right.
But they ran the numbers and found that recently, Bitcoin has actually been less volatile than NVIDIA.
Wait, NVIDIA, the stock market, darling. The AI chip maker.
The very same.
That's incredible. You always think of Bitcoin as the crazy cousin at the dinner table.
Not anymore, apparently.
Right.
And they argue this signals a maturation of the asset. Even if the price is down, the behavior of the asset is changing. It's becoming more institutional. It moves with the macroeconomy now, not just on its own wild whims.
So the asset is growing up even if it's throwing a tantrum right now. Which brings us to the next layer of this disconnect. While retail is staring at the sell button, Washington seems to be having a completely different conversation.
This is where we have to dig into the legal newsletters, the Lowenstein crypto newsletter, and the policy tracker. This is the stuff that doesn't go viral, but it's rewriting the rules of the game.
I saw the phrase Project Crypto in there. Sounds like a bad action movie.
It does, but it's very, very significant. Project Crypto is a joint effort between the SEC chairman, Paul Adkins, and the CFTC chairman, Mike Selig. They are finally collaborating to build a token taxonomy.
A taxonomy? That sounds incredibly dry. Why should someone who's down 20% care about a taxonomy?
Because for the last decade, the biggest risk was regulatory ambiguity. Nobody knew if a token was a security, like a stock, or a commodity, like gold.
And the rules are completely different.
Completely. If it's a security, the rules are incredibly strict.
Mm-hmm.
Project Crypto is the regulators finally sitting down to write the dictionary. It's the clarity that allows the real whales pension funds, sovereign wealth funds, to come in.
So instead of suing people for breaking rules that don't even exist, they're writing the rules so people can actually follow them?
Exactly.
Yeah.
They are building a bridge toward what they're calling the Clarity Act.
And it's not just the regulators. The policy tracker details a meeting at the White House.
Yes.
You have crypto execs sitting across from traditional bank CEOs.
Right, the grown-ups. But from the notes, this was not a polite tea party. It was a brawl.
A brawl. What were they fighting about?
Stablecoins, and specifically the yield, the interest you can earn on them. The
Okay.
banks presented a document demanding an outright ban on stablecoin rewards.
Let's unpack that. Why would a bank care if I earn 5% on my digital dollars?
Because they see it as an existential threat to their deposit base. I mean, think about it. If you can hold a digital dollar on your phone and get 5% yield, why would you keep your money in a checking account that pays you, what, 0.01%?
You wouldn't. The bank loses your deposit.
And if deposits leave, the whole banking model is in trouble. So they're lobbying hard. They're trying to protect their turf.
That makes perfect sense. So it's not about consumer safety. It's purely about competition. They're worried about losing customers to a better product.
Exactly. And to be impartial, it's not just the banks. The report notes that Senate Democrats have conditions too. They want a ban on the revolving door of government officials going to crypto firms, and they want the CFTC fully staffed.
So it's messy.
It's very messy. But the fact that this argument is happening in the West Wing, that's the takeaway. The industry has graduated. It's now a priority policy issue for the national economy.
Speaking of national stakes, let's pivot to the heaviest document in our stack, the SEC White Paper, Securing Digital Dollar Dominance. This one feels like a turning point.
It absolutely is. If you only remember one thing from this deep dive, let it be this. The U.S. government appears to be shifting its strategy from fighting crypto to, well, to weaponizing it.
Weaponizing it, that's a strong word. What do you mean by that?
I mean, using it as a tool for geopolitical power. The paper introduces this concept called synthetic dollarization.
Okay, break that down for me. Synthetic dollarization.
So, private companies like Circle and Tether issue stablecoins, right? These are digital tokens backed one-to-one by the U.S. dollar. They make up over 90% of the $200 billion stablecoin market.
And people all over the world use these.
Exactly. People in Argentina, Turkey, Nigeria, places with failing local currencies, they're using these to save their money. They're opting into the U.S. dollar economy, but through a blockchain, not a bank.
So the government is looking at this and saying, wait, we don't need to build a digital dollar from scratch. The private sector already did it for us.
That's it. The SEC is realizing these stablecoins are a Trojan horse for the dollar. They extend U.S. financial influence globally. And they need this because the EU is rushing out a digital euro. China already has the ECNY.
They're competitors. They want to break the dollar's dominance.
Correct. So the U.S. strategy here seems to be let private companies win as long as they use dollars.
But there have to be strings attached, right? The SEC isn't just going to let them run wild.
Oh, massive strings. The framework proposes incredibly strict rules, 100% reserve requirements. Every digital dollar has to be backed by actual cash or T-bills. They are viewing stablecoins now as critical infrastructure for national security.
Moving them from the casino category to the plumbing category.
That's the perfect analogy. And that explains the bank's panic. If stablecoins are the new plumbing, the banks lose their monopoly on moving money.
There's also a detail in the policy tracker about Treasury Secretary Bessent and the Genius Act.
The Genius Act. You have to love the acronyms.
That's that about.
It's about the Strategic Digital Asset Reserve. Now, there was a rumor the U.S. would start buying Bitcoin with taxpayer money. Bessent clarified that's not the plan. The reserve is built from seized Bitcoin, assets from criminals.
Ah, so like the Silk Road Bitcoin.
Exactly. But instead of auctioning it off, the report mentions the reserve is now over $15 billion. The government is just holding it. They are effectively hodling.
Okay, let's recap the structural side. The government sees stablecoins as a tool for dollar dominance. There's a strategic reserve of seized Bitcoin, and regulators are finally writing the rule book. That all sounds incredibly bullish.
From a structural perspective, it is the most bullish setup we've ever seen.
But let's go back to the portfolio pain. If everything is building up so nicely, why is Ethereum specifically getting hammered so badly?
This is what we call the Ethereum paradox. And to understand it, we have to look at this analysis from Binance Square. It's all about Layer 2 networks.
Layer 2s. So networks built on top of Ethereum, like Base or Arbitrum, that make things faster and cheaper?
Correct. And they have been wildly successful. The stats show Layer 2s now handle 95% of all transaction throughput. Almost nobody uses the main Ethereum highway anymore.
95%. Wow, that sounds like a massive success story. People are actually using it.
It's a technical success, but it's an economic problem for the ETH token. The source describes the relationship as potentially parasitic.
Parasitic? That's a harsh word.
Well, it comes down to the revenue meta. See, when you transact on a Layer 2, you pay fees to that Layer 2. The analysis points out that Coinbase's L2 generated about $75 million in revenue last year.
And Coinbase keeps that money.
Exactly.
Yeah.
Base is becoming a super app. It's where the users are. It's where the fees are. Ethereum mainnet is just becoming the settlement layer in the basement. It's invisible infrastructure.
So, wait, let me get this straight. Using crypto has never been easier or cheaper thanks to these L2s. But because I'm paying my fees to Coinbase's Base or to Arbitrum, holding the underlying asset, ETH isn't capturing any of that value.
That is the core of the paradox. The analyst says 2026 is the end of promises and the start of proof. Investors don't want the story anymore. They want to see revenue. And right now, the L2s are capturing the fees, leaving the mainnet and the price of ETH struggling.
It's like you invested in the company that built the highway, but all the tolls are being collected by the guy running the toll booth.
That is a spot-on analogy. It's great for the user, but it's very confusing for the investor.
That is a tough pill to swallow for ETH holders. But before we wrap up, there was one other sort of bright spot. Prediction markets.
Yes, this connects back to our theme of regulation opening doors.
Yeah.
The CFTC, according to the policy tracker, formally withdrew its previous guidance that banned event contracts.
Which is huge for platforms like Polymarket, right?
Huge. It basically opens the door for legal betting, or hedging as they call it, on real-world events. Sports, elections, policy outcomes. They're moving away from calling it gambling and treating it as a regulated derivative.
So maturation really is the key word for today. The assets are becoming less volatile, betting markets are becoming regulated derivatives, stable coins are becoming national infrastructure.
And the price is crashing.
Right. Can't ignore that. So let's try to bring this all together for the listener who's looking at that red screen and wondering what to do. How do you reconcile all this?
It's a very strange state of affairs. If you look at the price, the sky is falling. Fear is at 92. ETFs are bleeding.
But if you look at the structure, you have Project Crypto writing the laws, you have the government using stablecoins for global dominance, you have the tech finally working at scale on L2s.
The disconnect is real. The price is reflecting immediate fear. But the sister itself is hardening.
It feels like a transition.
I think the Binance analysis put it best. We are transitioning from an era of storytelling to an era of revenue and proof. And that transition is painful for prices because utility is boring, plumbing is boring, but it's essential for longevity.
Which leaves us with a final thought to chew on.
It does, and it comes back to that SEC white paper. If the U.S. government views stablecoins as a tool for national security, and if Layer 2s are where all the actual activity is happening, does the price of Bitcoin or Ethereum matter as much as the utility of the dollar moving on the blockchain?
That is the question. We've spent a decade obsessing over the price of the coin, but maybe the next decade is about the value of the rails it runs on.
It's a question that might redefine how we all invest in this space. The value might not be in the asset itself anymore, but in the infrastructure that moves the world's money.
Well, on that note, we will let you get back to your charts, or maybe do yourself a favor and don't look at them. Go outside, touch some grass, and remember the plumbing is still being built. Thanks for joining us on this deep dive into the noise of 2026.
Stay curious.